sold. We think in terms of price patterns, secondary, but generally we think of a price being valued too low or too cheap, or expensive or too high. And the algorithm has similar thought processes built into it, and we look at it in the form of a premium and a discount market. For the sake of discussion, just think of this red line at the top as a resistance and a blue level in the bottom being support. As price starts to move away from a level that would be viewed as too cheap or support, naturally our expectations as traders, we expect to see price move higher. When it does this, we're confirmed to see a response moving up to a resistance point of some kind. Now the problem is with retail trading and with technical analysis as a whole, by itself it doesn't help you, because every one of us could come to the conclusion that a specific level above current price action would be a resistance level. Some of us will see it as an old low that it would be trading to. Some of us would see an old high. Some of us would see something else that would equate to a resistance level. Now, to remove all the ambiguity, you have to have a mindset going into it. And this teaching is to teach you the hierarchy on the tools that I use for framing the trades. Now, these same arrays are the same things that we've talked about since the beginning of the mentorship, but we're going to prevent you from having them in a disorganized fashion. In other words, there's an hierarchy in how they are used and how you look for them in price. As price makes a retracement lower from a support level, how far does it usually retrace back? All of us, again, based on different walks of technical analysis and different disciplines, will all have a different conclusion. Some of us would use a Fibonacci. Some of us would use some fashion of support and resistance. Some of us would use Elliott wave and ratios and harmonic patterns. All kinds of things would come by way of discussion if we were in a roundtable meeting. We're all sitting in the same room together. We all have different opinions about how far it would retrace. Some of us wouldn't even have expected a retracement. Okay, some of us would not see this as a retracement, but a beginning of an all-out reversal to trade below the old low. That's the problem every trader is plagued with when they come into this business. Who's right? Who has the means of knowing with great deal of prognostication what is a support level and what is a resistance level, and therefore what will propel price away from current market action higher or lower? Because the common adage is, if I knew where price was going next, I wouldn't need to know anything else. I would make money. That's not true, because you would find some other way to lose money, over leveraging or doing something different you shouldn't be doing, and you'll break a rule and you'll get an emotional or psychological impact because of that, and you'll end up blowing the account. So when we look at charts, we want to be viewing price in the terms of, are we in a premium or are we in a discount market? Earlier in the mentorship, I taught how you could do that, but we're going to talk a little bit more in terms of how to frame that on higher time frame charts in the form of an hierarchy with the arrays. As price starts to retrace and then moves higher, it hits a level of resistance. Now, for the sake of discussion, we're going to say we collectively understand what would deem a resistance level to remove all the secondary discussions that we could have if we were in front of one another in the same setting, in a live setting where we could literally shake hands and talk. All of us would have an opinion about what would constitute a resistance level. But we're going to say that this level that's noted as red, that is the commonly agreed upon resistance level. The reasonable expectation would be to see price move away. When price does that, some of us would expect one more try to get to that level, maybe to go through it or to fail. That's how I trade. That's how I expect to see price react. Some of us would not even expect that. They would expect this one-time punch up there and then all reversal. This is the type of setup I like to see here. Another pass towards that old high. Either it's going to give me a run through or a false break, or it's going to give me a failure swing. We talked about classifying institutional price swings. That's what we've done for that teaching. Here, I want you to start thinking in terms of premium and discount on higher time frame charts, because the hierarchy on how you view this is going to help you, whether you're a day trader, scalper, position trader, short-term trader. With the expectation of lower prices, how far would we expect to see price go down? Well, the first impulse leg, then retracement, then as a second leg higher hitting that resistance level. That secondary impulse leg, that's probably going to be a good reasonable expectation for support level. Now, it could be a bullish order block. It could be an old short-term high in there on a lower time frame. If this was, say, a monthly chart, at that low, there may be a daily short-term high that would create a support level that can't be seen on a monthly chart. So when we're looking at these higher time frame charts, just understand that there's going to be levels that exist inside of larger price swings that you may not see unless you go down to the lower time frame. Now, when I say lower time frame, I'm only referring to the daily, because the higher time frame analysis is all we're focusing on here, nothing below a daily chart. So if we're assuming that this is a monthly chart and we're looking at price, the expectation is okay, well, at that old low, we would expect to see some lower time frame support level. And again, it could be the monthly bullish order block, it could be a weekly bullish order block, or it could be a daily short-term high. You may not be able to see it inside that little low there. But nonetheless, when we look at price swings back and forth on a chart, whether it be monthly, weekly, or daily, and even lower time frames, you have to understand that there's swings that exist and support levels and resistance levels that exist in the lower time frames that may not be so apparent using these higher time frame charts. That is not what you base the majority of your trades on. What you're going to be doing is you're going to be using the monthly chart and the weekly chart to frame the context of what that market should be doing using these PD arrays. So if we watch price and it continues to trade higher here, where would you reasonably expect to see price trade to? That short-term little swing low at the failure swing. That's going to be what? A potential mitigation block. It means any orders that were used to go long but failed to make another pass at that old high, they're underwater now. So they're going to look to mitigate those losses and cover their long positions and go short potentially, or just get out of the trade. But smart money just doesn't cut losses. They know what they're doing. They scale in, scale out, and they hedge. So this would be another selling opportunity. The market seeks liquidity below the low and below the second impulse swing prior to the run into resistance. So it seeks liquidity below the marketplace. Once it takes that liquidity out, it can drive all the way down to that old support level, but generally it doesn't. It will retrace again and pick up more orders back at an old low, where we'd see another opportunity to sell off and take out the liquidity below a short-term low that was just created and back down to a logical area of support. The expectation would be what? To see price bounce. Price does this. When price starts to retrace again, some of us, if we were all in the same room, would expect to see that price low to be violated and a new low created. Sometimes that will happen. Sometimes it won't. This failure swing in here could be used to set up another long opportunity where price rallies. And here's the million-dollar question. The understanding is how price moves from one level to the next, but predominantly it's moving from a level of discount to a level of premium, from a level of premium to a level of discount. Between the red line and the blue line, they are extremes. In the middle, that's classified as equilibrium or balance. Buying imbalance is seen when price gets above equilibrium or up into that red level, which would be resistance. Selling imbalance would be when price gets below equilibrium and down into the blue line, or what would be described as discount. So where would you expect to see price go next? That's what you're always faced with when you sit down in front of the charts. This discussion, we're going to use the common ICT tools as far as setup parameters in the form of the way they form on charts. In other words, the order in which they form and how to use them based on wherever you're at in terms of the marketplace. We're using this teaching as a foundation that's going to lead us into a better understanding of this example we shown when we were discussing money management for the January content. So lesson 5, that example for the dollar-yen pair for a long-term position trade. This idea will be used as an example on framing PD arrays on higher time frame charts. But before we get into that teaching for 6.2, we have to do the foundation to understand what we look for and why we expect it to unfold like we would. Okay, again, using our thought process of premium, which would be the red line, and discount, which would be the blue line. When you look at charts, you want to see where price has moved away from an old high and it's dropping down from an area of premium. In other words, it's too high, so the valuation is going to be reduced and dropped lower. So repricing takes place and the market goes down and the price goes lower as a result of it until it gets to a point where it's too much of a discount. Then there has to be a premium built into it. The algorithm will do this, moving price back and forth, back and forth, back and forth, until, again, something of significant impact comes into the marketplace and drives the market one-sided, and it creates a strong imbalance. Otherwise, the market's just going to gyrate back and forth, looking for liquidity based on premium and discount conditions. We'll assume for a moment right now the market price is here. Okay, and we can clearly see that the market in recent times had a clear discernible level of resistance and a clear discernible level of support. Now, that can come in the form of bullish and bearish order blocks, or it could be just old highs and old lows. And we'll just use old highs and old lows as an example for this discussion. Your expectation is right now, price is at a level where it should, by all standards, move lower because it's at a classic viewed resistance level. We don't know how long that time is going to be required before the market does in fact submit to our expectation and see a lower price. So that time frame, okay, that part is what you're always going to have to submit to. Time is a murderer. It's a killer for traders. Unless you know that some of these ideas are going to pan out for a long, long time, you're going to do a lot of things psychologically and emotionally that you wish you wouldn't have done because you haven't submitted to the time aspect of trading. There's two elements in trading you have to submit to, time and price. When they both agree with one another and you have waited for that agreement to come to fruition, that's where profitability and opportunities are. So we're looking at price, and we have no idea how long time is going to be required of us to wait before the displacement takes place. But eventually, our expectation is we'll see lower prices down to a level of discount. And that's what we're expecting or forecasting as a future price. In between these two reference points, again, time and price is what's essential. You have to submit to the level of time, which no one knows how much time is going to be required before your setup pans out or goes to profitability. Price is what you're studying. You're submitting to time throughout the process, but while you are in the trade or expecting this to unfold, studying it, you're submitting to the price. You know what? You're not trying to force your will on price. You're analyzing price to see what it is that it's telling you in terms of institutional order flow. Is it justifying your expectation that it wants to go down to that discount level or some bullish order block to buy back off of and cover a short position? Or it could be a old low that it wants to run below. That future price could be a number of things, but for now, we're just going to aim for an old low. Between the market price today and the future price that you anticipate or forecast lower in the future, there's going to be zero opportunity for it to be a straight line. In other words, you're not seeing that diagonal line in the way the market trades. It just doesn't do that. There's always some give and take that takes place. So understanding where certain arrays occur in that process will help you, number one, stay with the trade idea, not be shaken out of it, and have the confidence to hold until the objective is met, or your stop gets taken and it's simply moving to a next opportunity. The opposite scene, when you're looking for a bullish scenario, everything's just reverse. You expect market price to be in the future at a premium. In other words, it's going to be higher than it is today. Again, you have no idea how long time is going to be required to get to your future price or forecasted price. And you have to submit to that a measure of time that is unknown You can't know for certainty how many days or how many hours or how many months it will be before that price is actually arrived at, or if at all. But you also have to be studying price. And again, monitoring and studying the PD arrays that occur in price action that leads to supporting your expectation on institutional order flow that would drive price up into that premium level. The understanding is that price will move from a discount to a premium because the discount can't stay discount very long. Price is going to be established by whoever is selling it, who stands to make a profit off of it. Well, the central bank is going to be in the business of adjusting price. So if we know that they are in control of price ultimately by way of steering sentiment and economies through the delivery of an interest rate long term to stimulate or to suppress an economy for a country, we have to view the market in terms of technicals to align ourselves with these ideas. So if we see a level of support, our expectation is, okay, where is the evidence that this thing will go to a premium market? Where's the premium market? Where's the resistance at? Where's the higher level that I would want to see it trade to? Between the market price you're at right now and that future price, again, it never happens in a straight line. There's time that you have no understanding of exactly how long it's going to be, but there's also an element of price that you have to study. In other words, just because you think it's going there doesn't mean it's going there. It could go halfway there and fail and go lower. Nonetheless, what we're going to do is we're going to outline now the arrays and keep them in a specific order so that way you know wherever you're at in terms of market price, what you would expect to see or what you're looking for, okay? In other words, what should I be looking for, an order block, or should I be looking for a gap? What should I look for right now? That's what this teaching is going to do. Okay, for a monthly chart, okay, what you're going to do is you're going to look at the current trading range that it's in, okay? And so we're going to assume that you outline the marketplace in terms of old highs and old lows on the monthly, and that's the easiest way of doing it. There's other ways you can do it, but for now, we're just going to outline it in the context that the most recent trading range that the market has moved from an old high to an old low, that would be our premium and discount definition. In between these two reference points, the halfway point, this is always going to be referred to as equilibrium. Now, equilibrium between where you think price will go because it's been there before and where it's at right now relative to an old high and old low, that's the current trading range. And I'll give you an example of what that looks like when we go into lesson 6.2. But for now, I want to lay the foundations for what it is you look for. The first thing above equilibrium in the form of an array is an old high and old low. You want to be looking for that above equilibrium. The next thing that you'll be looking for, and this is in the order of importance, okay? Old high, old low. Then the next thing you'll be looking for is a rejection block. A rejection block will be just above the candle's body, not the wicks. So the actual high and low is the wick. But then the next area of importance is the rejection block that would be just above the candle's body. Then the bearish order block, a fair value gap, a liquidity void, bearish breaker, and the mitigation block. Put another way, if we were at equilibrium and we were moving away from a premium level or at resistance, in other words, price has already dropped down, and we anticipate price going lower down to a level of support or monthly discount, we would be looking for above current market action, again, assuming that we're at equilibrium right now, we would start looking above current market action in the past on the left side of our chart. Where's the nearest mitigation block? There may not be one. Okay, check that off. Where's the nearest bearish breaker? There may not be one of those either. Okay, check that off. But if there is one, then you would reasonably expect to see price trade up to that price point, the breaker. Then expect some selling to go lower, and once it moves below equilibrium, then you would be all set to go to the monthly discount or support. But let's assume for a moment the mitigation block isn't there and the breaker isn't there. What would you look for next? Okay, well, the next order of hierarchy is liquidity void. Is there a range that needs to be closed in? Again, that may not be so clear. Check that off, no problem. The next thing, is there a fair value gap? Again, that might not exist either. go to the next thing. Bearish order block. That's probably going to be there. Chances are it's very strong that's going to be there. So what did this give you? I gave you the hierarchy in which you look for a mitigation block. Is going to be first considered before you get to the bearish order block, because the bearish order block is going to be really high up in the premium. Mitigation block is going to be the lowest. Mitigation and breakers are basically mitigation blocks, but generally mitigation blocks can occur lower than breakers. Small little bounces in bear markets would be a mitigation block, basically. A bearish breaker will keep your ability to get to a bearish order block, which will be resting higher up in the premium. When an old high is taken out, that down candle right before the second high is made, taking out an old high, or turtle soup in other words, that down candle, if it's retraded to, that's going to be a bearish breaker. That's going to keep you from seeing, most likely, high probability that it won't allow you to get to a bearish order block. So whenever you see bearish breakers, just don't expect the bearish order block to be hit, okay? Because it's going to most likely keep price lower, because that's going to be the most dominant array of all these in here. There is a liquidity void that would be viewed if there's no breaker. You can close in that range, and that may take you up into a fair value gap or a bearish order block. But breakers by themselves, even though they're low end on this list, it's the first thing you're going to encounter, because if you're at equilibrium and price has already been moving away from the resistance level, you're looking up now for any potential areas to resell at. First one you look at is the mitigation block or bearish breaker. And if there's neither of those, you look for a liquidity void to trade up into to close in that range, or fair value gap to close in. It may not be any of that. Then you would expect to see the bearish order block to be traded to. Then that would be your selling opportunity, because you're at a premium and you go to a logical area where institutional order flow would kick in, new orders would capitalize, and then the selling would ensue. If there isn't an obvious bearish order block, okay, and there's very little times that's like that, but we will talk about that when we get into entry techniques and concepts. But if there is a lack of bearish order block, understanding in what you're looking at currently in market action, because there may be a lot of wicks, something like that may occur, then you would look for a rejection block, which would be just above the body of the candles. You would expect that to be ran out, and then you'd be really high on the premium there, and then ultimately a whole entire run on the old high. That would be an expectation. Now, I have here old high and old low. Why would the low be there? Well, if you're on a very low end of a downtrend on a higher time frame monthly chart, you may be rallying up to a old low. And if it gets to that old low, even though it's an old low in terms of price, it's really high up in the premium if it's been rallying a considerable amount of time and in price to get to that level. So retrading to an old low, that's resistance, classic understanding, but it may need to run out an old high as well. So basically all you're doing is you're scaling the grade of how much importance you're going to have on each one of these. So again, in summary, I want you to understand what I'm talking about here. We're not just listing the things we've talked about in previous teachings, okay? I'm putting them in an order of significance. When you're at equilibrium, or if you're moving up from discount, okay, your expectations are to look for, very first thing you look for in the list as price is going up, the first thing you're looking to see, to encounter, is there any mitigation block that I got to consider? Because that's the first objective. It could be a selling point. Then it's a bearish breaker. That could set the tone for another leg lower or stop any rallies on a bullish idea. Then the next idea, if you're bullish from a discount or if you're expecting a new selling opportunity, say you're at the equilibrium price point, anything below the premium, the expectation is when you're looking up in price for areas where price may go up to, it's in this order from the lowest up. In other words, from mitigation block all the way up to old high and old low. That's the order you would expect to see them. Now, the order of importance, in other words, the highest of the premium array, is the old high and old low. That's as high as you can get. Then you have rejection block. Then you have bearish order block, fair value gap, and then liquidity void, bearish breaker, and mitigation block. You're going to be looking up And the first thing you're going to encounter is the first thing on the bottom of this list, and then you start working your way up that list. The farther you go up in this list, the more deeper you go into a premium market. Certain arrays in here will keep you from seeing the next higher array. In other words, the next institutional order reference point that's listed in here, if you get to a breaker, chances are you're probably not going to go higher than that. You won't generally get up in to close that void. If there's a breaker below a liquidity void, the liquidity void may stay open, basically. That range may stay open. So they kind of like, it's in the order of importance as a trader when you're below premium and looking higher up for prices or expecting prices to move higher. That mitigation block, that's the lowest or the most likely one you're going to expect to run into first. It doesn't mean that there's one in price action, but you start from that expectation first and you look for it. If it's not there, okay, what's the next thing you've been looking for? The bearish breaker. If it's not there, okay, then I'm okay to expect that void to close in. But there may not be a void. It may have been a really systematic and efficient way that it traded lower, and that won't be any void there. So next thing is, there's a gap that would draw price up into it. If there's no gap, then you go right to the order block. Okay, but the main thing is, if there's a breaker, forget about closing in the void and forget about getting up to that gap, because the breaker is going to take precedence over everything on this list when you're below it in terms of market price. If we were anticipating move lower into price, into a discount, or into a support level, we would expect the very next PD array to be a mitigation block. Now, again, that may not appear in price. If there is no mitigation block, you would expect to see the next PD array in the form of a bullish breaker. And again, this may not occur or be seen in price action, but this is the order in which you would expect to see as prices going lower. Looking in the past to the left side of your chart, you're going to be focusing on whether or not these arrays appear in price action. Their importance is listed from equilibrium, the expected order of how they're going to be in the price action in the form of a discount. The first one you would anticipate seeing is a mitigation block bullishly, then a bullish breaker, then a liquidity void. Now, if there is a bullish breaker, now again, a bullish breaker is a up candle between two swing lows, and the most recent swing low would be lower. In other words, you're seeing a stop run in the past. And the high, the swing high that it forms between the two lows, that up candle is going to be your bullish breaker. So when price comes down to that bullish up candle, it'll find some support. If you see that in price action, chances are if there's a liquidity void in price, it won't go down to fill that in. It can if it overtakes the breaker, but if it has a breaker, anticipate price not going below the breaker and leaving the void intact. Again, assuming there is no breaker and there is no void, but there is a gap, and it may be a liquidity void and a gap. Sometimes that can occur too, but you would anticipate price reaching down into a fair value gap, which is just a common little gap where price has only been delivered on one side of the marketplace. And then the next array would be the bullish order block. And again, without the breaker, you would expect the void to be filled, a gap to be filled, trade down into the bullish order block. Then below the order block would be a rejection block, which is just below the most lowest candle and its body. In other words, if it has wicks, long wicks below it, we're only going to be looking for a move just below the bodies of the candle, and then that would be a rejection block. And then ultimately, the deepest form of discount would be in the form of an old low or trading down to a historic high. And like we said when we were talking about the premium market, when prices trade up to an old high, it can also trade up to a very old long-term low, and that would both be in the form of a resistance level. So when we look at markets like this, what it does is it gives us a framework. You can see here the monthly premium arrays. These are going to be focused for primarily bearish premium array trading. In other words, you're going to be using these areas at which to frame a trade or look for bullish targets at these levels. For monthly discount, your bullish discount arrays, these are your bullish discount arrays, and you would be looking for these for bearish targets or looking to get long at any one of these based on the current conditions in the market. Now the same thing is seen also for the weekly chart. The weekly chart, you're going to be looking at the same thing from equilibrium up. The first thing you would expect to see when you're expecting higher prices, are we going to run into a mitigation block, bearish breaker? If there's a bearish breaker, you're probably not going to go higher than that. But if there is no breaker, you look for a void to close in or a fair value gap. If there is no fair value gap or a void, price could just simply trade right up into the bearish order block. And if there is an idea that suggests that there's possibly not a strong bearish order block there, we would look for a rejection block, which is a move above the candle's bodies if there's long wicks that top that market, and then ultimately a run above the old high or return to a historical low. The same things we just outlined for the monthly is seen for the weekly, both premium and discount. The same hierarchy in how you would expect to see these arrays occur in price action. This is the way they are seen. And obviously the same thing is said for a daily chart. Nothing's changed. The same hierarchy exists. If we're at equilibrium, and that's the current market action price, and we're expecting lower prices, the first thing we want to look for on the left side of our chart, is there any mitigation blocks or a bullish breaker? If there is, anything less than that breaker probably won't be considered or retraded to. The breaker has precedence over everything, both bullish breaker and bearish breakers. So we're going to take a look at an example of all this information with our dollar-yen example that we mentioned briefly in lesson number 5, money management with higher time frame analysis. Using these ideas in 6.2, that lesson will actually give a real practical example.